Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Oil price and the Bitcoin market. In this study, we analyze the nexus between oil prices and the realized volatility of Bitcoin returns. The association between crude oil and Bitcoin can be likened to a complementary supply. Oil is a major resource in Bitcoin mining. Bitcoin mining alone, for instance, consumes about half as much electricity in a year as all of the UK. As such, an alternative source of energy, such as crude oil, becomes imperative. Further stressing the exigency of energy in the mining of Bitcoin, efforts have been made to explore the stranded gas option to support energy demand in the mining of the digital currency. By implication, without energy sources, mining and investment in Bitcoin may not be possible. Furthermore, Bitcoin can be thought of as a commodity that can be influenced oil prices owing to the strategic nature of the crude oil market. Hayes, 2017, identifies a Bitcoin cost of production model and finds that factors that lower Bitcoin production costs, such as a global reduction in electricity or oil prices, lower mining difficulty, and higher mining efficiency, have a negative impact on the Bitcoin price, while those that make mining more difficult raise the price. Moreover, an increase in oil price could lead to inflation, causing real income and firms' profit to nosedive, and also diminish public confidence, thereby making an investment in Bitcoin, as a hedge against oil price risk, necessary. The increasing attraction to Bitcoin is an indication of its wider acceptability, and may therefore respond to some fundamentals that typically influence financial markets in which oil price plays a key role. For instance, 50 units of Bitcoin transactions were reported in January 2009, which later grew to over 17 million by December 2017. Consequently, the number of businesses that are now involved in Bitcoin transactions is over 100,000, with about 10 million people possessing significant amounts of Bitcoin as a financial asset around the world. More recently, the price of Bitcoin has risen to more than $26,600 in June 2, 2022. Although arguments abound that owing to the unique elements that drive its price dynamics, Bitcoin is isolated from economic and financial fundamentals. Some analysts are gradually beginning to study some risk spillovers between the crypto market and the crude oil market. It was observed that between early January and February 2023, the volatility of West Texas Intermediary rose from 38% to over 100%, whereas Bitcoin's volatility fell from 60% to 40% in the same period. While it would be premature to say that Bitcoin is currently a safer asset to hold than traditional commodities, one may rationalize this on the basis that investors in countries with high levels of inflation may seek a safer asset that is more accessible, transportable, and liquid than something like gold, which is conventionally considered to be a defensive asset. This argument of the safe haven possibility of Bitcoin against oil risk seems to have been strengthened after the events surrounding the U.S. Iran political tension, where post the U.S.'s targeted killing of Iranian military leader Soleimani, Bitcoin prices on local Iran-based OTC exchanges jumped to levels over $20,000. From a theoretical perspective, an decrease in oil price is expected to influence Bitcoin production negatively, positively, and more of it would be produced. This tends to increase the activity in the digital currency market, and thus its return volatility. Relying on this, we hypothesize a negative connection between oil prices and the realized volatility of Bitcoin returns. We acknowledge that studies have evolved to analyze the relationship between oil and Bitcoin from different perspectives, and they can be largely differentiated based on how the two variables are measured. Some of them express these variables in terms of price, returns, and volatility, among other relationships oil might have with Bitcoin. Similarly, the hedging potential of Bitcoin for oil risk has been examined. The cue from these strands of the literature suggests that a relationship does exist. Furthermore, some other studies have identified other fundamentals such as macroeconomic news, stock market dynamics, economic policy uncertainty, EPU, that influence Bitcoin volatility. Notwithstanding the strength of the literature on the subject, our contributions are not far-fetched. First, we offer both the in-sample and out-of-sample connection between oil prices and the realized volatility of Bitcoin. Moreover, our interest is to assess how oil price swings, upward or downward, can affect the Bitcoin volatility either by lowering or raising it. The specific objective examined here appears to be the first attempt in the literature, as related studies are limited to in-sample predictability and often focus on volatility transmission and hedging possibilities. In finance, out-of-sample forecasts offer useful insights into the expected utility gains derivable from existing and future investments, particularly for forward-looking investors whose expected returns respond to changing economic conditions. Second, and from an investment perspective, we demonstrate probable utility gains that can be derived from observing oil price dynamics when investing in the Bitcoin market. Finally, while this is not intended, we can also tease out from the predictability analyses any possible hedging potential between oil and Bitcoin. Foretelling our results, we find that oil price predicts the realized volatility of Bitcoin's returns pretty well, and the two are inversely related. In essence, higher oil prices are capable of lowering the volatility in the Bitcoin market. In other words, as oil price increases, the production cost of Bitcoin also increases, thus lowering the potential of the crypto to make higher returns, which by extension lowers its trading and volatility. Our results hold for both in and out-of-sample analyses. While the inverse association between oil and Bitcoin suggests a possible hedging relationship between the two markets involved, we also document some economic gains of observing oil prices when trading Bitcoin. We examine the predictability of oil price for the realized volatility of Bitcoin returns. We are motivated by the fact that oil serves as a major input in the production of Bitcoins, and therefore, we are hypothesized that observing movements in oil price may improve the predictability of the realized volatility of Bitcoin. The choice of volatility rather returns is farther motivated by the need to understand the risk associated with Bitcoin when oil price swings are observed. Investors often pay attention to risks, whether diversifiable or non-diversifiable, when making investment decisions. Unlike the existing literature on the subject, we look beyond the in-sample predictability by extending the analyses to include out-of-sample forecasts, since the latter is more useful for evaluating the predictive power of predictor series. Thereafter, we investigate possible utility gains of observing oil price when taking investment decisions about the Bitcoin market. Given the observed trend in the realized volatility of Bitcoin, we also account for structural breaks, derived from the using by and Perron, 2003, multiple breakpoint test, in the predictability analyses. We find evidence for at least two significant breaks, with one of them aligning with the period just before the WHO announcement of the COVID-19 pandemic. Our findings are summarized as follows. First, we find a negative and significant relationship between oil price and the realized volatility of Bitcoin RV. Expressly, the realized volatility of Bitcoin declines with rising oil prices. We can further discuss this in terms of how trading, and by extension volatility, in the Bitcoin market may be adversely affected by upward swings in oil price. This may not far-fetched as increases in oil price raise the production cost of Bitcoin, which may reduce the profit margin and by implication the value of Bitcoins. Second, we show that including oil price in the predictive model of Bitcoin RV improves both its in-sample and out-of-sample forecasts. The proposed model that accounts for oil price consistently beat the benchmark random walk model that ignores it. Finally, we extend our analysis to include the economic significance of our proposed model to an investor seeking to maximize utility. We show that observing oil price when investing in the Bitcoin market may yield higher economic gains. Therefore, return-seeking investors in Bitcoin market are encouraged to pay attention to the dynamics of international oil prices, as they have the ability to influence the volatility formation of Bitcoin significantly. Likewise, practitioners and academics who are constantly involved in the analyses of financial markets may find our proposed model and the various conclusions insightful, particularly in terms of producing more accurate forecasts when analyzing the risks associated with the Bitcoin market. Future research may consider whether the above findings can be generalized to include other cryptocurrencies.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.